Hey traders, this is Christian Fromhertz, CEO of Tribeca Trade Group, with a weekend video for you. And I'm just going to be discussing the major U.S. indices in this video. I realize that my weekend videos sometimes run a little bit longer because I cover so many topics. So this one's going to be a short video, just looking at the U.S. indices because we are entering the month of April. And if you've watched my videos before, you know that I rely on the value areas, which will show where volume has been, where the highest volume is at price. So April, it looks like for SPYs, it looks like the price action, we're going to open up right in the middle of the value area for April. Again, this value area is based on the price action. You could see the market profile of a standard deviation of where that price occurred in March. And they often will really act as great support and resistance levels and will kind of give us a little bit of a signal. So the one thing that I noticed for SPY is that we are going to, unless something crazy happens on Sunday night, which I hope it doesn't, it does look like it does appear that we're going to open up inside value for the month of April. Has this happened before in the last few months? Yeah. If you look at where it happened, if we scale back a little bit further, we did this for the month of October. We opened up in value, kind of on the upper range, but notice we kind of chopped around for all of October since we opened up right in the middle of it. We also did this in January. You know, if you go further out, obviously this was the election, and we rallied big, and we went all the way through the value area very quickly. In November, December, we started on the upper side of the value area and powered through it. And then in January, we did the same thing. We started the month inside value, and look at the majority of the month up until right towards the end, where we climbed out of value and actually ended the month in value. So kind of a false breakout in January. And then in February, we had a nice rally where we started the month above value. So just looking at the comparisons of what we did in January, it looks comparable to where we're going to start the month in April. So there's a strategy that I wanted to cover here, and it's either to sell an iron condor or to not sell an iron condor based on the technicals. So before I discuss this strategy, I just want to cover the other indices because they look a little bit different, and I just wanted to give you a point of view. The Qs, they've been the market leader in terms of the major U.S. indices. They're going to open up, it looks like, above value. So I think you can remain long the Qs here, and you've got your support 131.76. So in this case, the trend is your friend as long as we're above 131.76. Continue to stay long the Qs. If they get into value, you know, maybe abandon that strategy. IWM has had a lot more volatility than the Qs and SPYs. You know, this is pretty interesting to me because we don't really see an MACD crossover yet in the SPYs or in the Qs, but, you know, IWM was kind of troubling. We could see this gray line is the 100-day moving average where we caught support last week, and it's bouncing quite nicely. It's got a chance to, it looks like it's going to open up in value for April, but on the top side of it, so we won't have far to go to really break out here in small caps. Also, again, it just fired off an MACD crossover. So I like, you know, possibly giving small caps a long or starting a long in the small caps. Also, you could see these two moving averages appear to cross over, which is also bullish. I'm waiting till we get above value 138.15 to play a breakout. That's how I like to trade is look for breakouts. So that's what I'm watching for April. So much different appearance, I think, IWM and Qs versus SPY. We'll go back to SPY for a minute. So now the trade is, notice we don't have an MACD crossover yet. We do have a small buy signal on the Raptor indicator, which is the Tribeca Trade Group momentum indicator. So what I would be watching here is, again, where we're going to start for the beginning of the month. The one comparable that I will say, if you remember from 3 months ago, what's similar this January versus April? Well, it was earnings season, which I think is an area that could be a choppy time frame. And we don't really start earnings season next week, the first week of April. We start it the second week, and you can see a lot of the banks report. They often kick off earnings season: J.P. Morgan, Wells, Citi, BlackRock, PNC, and then after the week after that, then we really get rolling into earnings season, where you get a lot of the big companies start to report. So this could be a trade that you consider for the first week of April. And I'll show you a trade that I tailored for this. So the one thing so selling an iron condor. First of all, if you're not familiar with the strategy, what is it? It's selling an out of the money call spread and collecting premium, and selling an out of the money put spread and also collecting premium. The beauty of doing both at the same time is you can only lose money, if the market does trend one way or another, you can only lose money on one side. So for example, if the market rallies, you'll make money on the put spread, but you'll lose on the call spread. You can't lose money on both sides, unless you apparently take one off earlier. Same thing, if the market breaks down, you'll make money on selling the call spread, but you'll lose on the put spread. The optimal strategy, the optimal result is if the market kind of chops around. So if we chop around like we did last January, last earnings season, it could be a winning trade. So that's the positives of this trade. The negatives are that there isn't much premium to really collect. Why is that? That's because the VIX is so low. So the VIX is only a 12 right now, so you could be saying, hey, well, I don't want to do this strategy right now because there isn't a lot of premium to collect. I'm going to wait for volatility to increase. The problem with that is if you kind of look at this chart, there hasn't been volatility for a long time. So if you've waited for a long time to put this strategy on, you may be continuing to wait even longer because we just haven't had it. I can't tell you when we're going to get more volatility, but looking at the last, going back on this chart from obviously from November, it just hasn't been present. So obviously, if things change and volatility creeps up, then there's other strategies that we can do. But until it shows its face, it just hasn't been there for months, and I can't predict when it will. So the best we could do is trade the market that we have in front of us. So there's not a ton of premium to collect because the volatility isn't high. So out of a range of 1 to 10, on how I like this trade of selling an iron condor, I would say probably about a 6 to a 7, so probably a 6.5. Again, and the reason why it's not higher is because there's just not a ton of premium to collect. However, it suits my portfolio because I'm mostly sitting long, and if we do get more of and I'm sitting long in a lot of swing option positions, and if you trade options frequently, and you're positioned to the long side, if you get a choppy market, your premium is just going to decay away on those long option premium trades. So this is a trade that can kind of counteract that a little bit, where you're selling a little bit of premium. This way, you're earning something. Well, if you're longs, if we don't get a next leg higher in the market, so that's the strategy behind the trade. And it really, depending my rank on that strategy is a 6.5, and it depends on how you're positioned. If you're positioned very lightly, that this strategy, and you're kind of just you're waiting to see the market kind of move to the next in the next direction, then this strategy may not be exactly for you. It really depends on how you're positioned. So that said, and this is all this, and the reason why I bring that up as well is because of the strikes that I've chosen on this iron condor. So again, because I'm positioned long, what could really hurt me is if the market sells off. So I structured the width of the put spread strikes a little bit more narrow than I did with the call spread, because theoretically, if the market does move up, I'll start to make money on my long positions, my single stock positions, and the width of the call spread can be a little bit wider because I won't get hurt that badly, because I'll be making money in other places. All right, so what I did was I only went out to the end of the month options, And you could do this as well with SPX. SPX is probably a little bit more favorable because of the tax treatment, but for illustration purposes, this is what I chose to do. And I'm looking at the April 28th, 239, 242 call spread. So if we go back to SPY, why I chose these strikes is I'm looking at the top of value. So I'm thinking that with earning season, we may just chop around inside. So I'm taking the strikes and I'm going outside I'm going right to the top of the value area and going out. So 239, I'm selling that and buying the 242. And on the other side, on the put side, I'm selling the 233 and a half. So I gave myself a little bit more bumper room with this one, again, because of how I'm positioned. So I gave a little bit more, um, a little bit more, what's the right word I'm looking for? I guess bumper room is fine. I'm giving myself a little bit more tolerance on the put side in case we do get a little bit of volatility to the downside. Again, because that's how I'm positioned, is I'm more positioned to the long side. I don't really want to get hurt if we have a little bit of volatility to the downside. So I chose the 233 and a half, selling that strike and buying the 231. Again, that's only $2.50 wide. So the most that I could lose is if we do break down to the downside is $2.50 minus the premium that I'm collecting on both the call and the put spread because I'm selling them both. So that's $1.24. If we actually ramp up, the most that I can lose on that side is the width of the if we happen to go through 242 on the spies, I'll lose $3 minus collecting the premium of just about 1.25 on that. So again, you always want to know what your risk is when you're tailoring these strategies first, and then look at how much you can earn to put that in perspective. So this strategy, again, I like probably 1 out of 10, about 6.5. Again, the reason why is because there's just not a lot that you can collect in premium. But if we chop around for the month of April, this strategy will allow you to collect some premium of about $1.26 on this trade. And again, this is something you can kind of maybe wait a couple days on until because again, I think this is really the market gets really choppy once we get into earning season. So you could wait a couple days for this and see if you can possibly earn a little bit more premium if volatility does tick up a little bit. Where you would bail on this strategy, again, you always want to think about where that would happen. If we start to get to one of those downward barriers, which is the bottom of value or the top of value, that's when you want to think about either rolling one of those sides out. So we don't have to worry about it right now, but in any event, that's a strategy that you can do and to capitalize on a neutral market or a choppy market for the month of April. So thanks for watching today's video, and I hope that helps you in your trading. Have a great day, and look out for the next video that we'll be shooting this weekend, which will be not on the sectors, but it'll be focusing more on sectors and then focusing more on international markets, which that's where I'm really excited right now in this marketplace. So thanks again for watching, and have a great weekend.